Look, let's face it, no one likes market declines and recessions. And if you're a new investor, chances are this is your first bear market. If so, keep in mind that there's often light at the end of the tunnel. Because when we look at market data stretching over 70 years, we see that with falling markets comes rising opportunity. Let's take a closer look at the data. This table breaks down historic market declines by various levels of drawdown and shows how markets have performed afterwards. Let's focus on the first column titled Drawdown. This shows the level of percentage decline the S&P 500 experienced. The second column shows the portion of percentage of all total drawdowns these specific pullback levels represent from 1950 to 2021. For example, lower declines of 0 to 5% represent 50.9% of all the drawdowns that have occurred during this period. And steeper drawdowns below occur less often, meaning they represent a smaller portion of all drawdowns. The last three columns show the percentage gains over different periods in the market after a market decline. One way to better understand this data is to imagine a rubber band, where the harder it's pulled in one direction, when released, the more aggressively it eventually shoots in the opposite direction. Well, the data shows that markets can behave in a similar fashion. For example, the S&P dropping between 20 and 25% accounted for 3.4% of the drawdowns during the period, and the index gained 11.5% on average the following year. Let's take a look at a steeper drop of 45 to 50% declines. Here, the market has historically witnessed returns of 14.9% 3 months afterwards, 31.1% returns 6 months later, and 46.4% returns over the next 12 months. Overall, it appears that the steeper the market declines, the greater the returns ahead. And that means there may be investing opportunities to be had when declines occur. Another thing to consider is as market declines go steeper, they occur less often. For example, 5 to 10% declines represent 18% of the declines witnessed since 1950. But larger drawdowns of say 25 to 30% only occur 1.5% of the time. In other words, not only do the larger drawdowns bring about greater returns in future periods, they also are historically much rarer, which suggests the chance to capitalize on them comes few and far in between. If investors have a long enough time horizon lasting a number of years, the data suggests there's some wisdom in staying invested in market downturns and even buying the dip. While market downturns are never a fun time, they are a normal part of investing. And history serves as great guidance for investors who want to learn from it and make better decisions as a result of it. But remember, while the past may serve as a great tool, it isn't a guarantee for what's to come in the future. For greater context on market drawdowns and the opportunities they may bring, check out our video on the history of market declines. And stay tuned for more recession-related content we have in the pipeline.